Okay, we're going to go ahead and get started. So I want to welcome everyone and thank you for taking the time to spend with us to increase your knowledge about finances. This is going to be about key principles that's going to help transform your life financially. You know, these are some of the things Demille is going to talk about is what they don't teach us in school. I wish, like I'm 60 years old, I wish I had learned all this stuff in high school so you could start implementing this. There are ways that you can just save, $50 a month, and by the time you're 65, you're a millionaire. They don't teach us things like that. But with the way technology is now, we can learn these things virtually. There are seminars, webinars. Now we're in COVID, so we can sit at our home and learn this. We don't have to go to a room full of people and learn that. So I wanted to take the time now to introduce Jamil to you. A little bit about me. I am Vanda Crossley. I'm with eXp Realty. I am a grandmother, mother, um, educator. I've been an educator for 20 years. I am a real estate mentor. So I love giving back and I love sharing. So I'm in that phase of life where, you're sharing and you're giving back to younger people. So when I met Demille and he told me what he did, I said, well, we gotta get this on tape, record it, get it out there to people. So a little bit about Demille. Demille, he's been involved in financial industry for over 10 years. He comes from an IT background and then he went into finances. So now he's shifting and putting the finances with the technology. And he says that, let's see, these things can change your life. And he decided that he would spread the word to the community. He's a world traveler, adventurer, a licensed financial professional who enjoys a good laugh with friends and family. And I love a good laugh too. So when Demille and I met, we've just been friends for the last couple of years. So let me introduce Demille Brown.
All right, all right. Thank you, guys. Hold your applause. Hold your applause. I'm just kidding. All right. I'm just kidding. Stop it. I'm just kidding. Um, thank you guys for joining this evening. I'm gonna make this, as lighthearted as I can be. I know sometimes talking about your finances is not the most exciting thing. It's kind of, like watching paint dry at times. But I'm gonna try to make this exciting because this can be something that's impactful, not only in your life but people around you's lives. So I want to say thank you, more importantly, Vanda, for sponsoring this event, helping me with this process, and getting the word out about what it is I got going on, what I'm doing. All right. So thank you for that first and foremost.
You're welcome.
All right, so let's kind of jump right into it. Let's see if I can, it's gonna let me do it. Okay, cool. So here's the thing, guys, and I start with, people ask me all these questions, right? Why are people having so many financial challenges? And I found that the main three reasons is, one, most people don't get a financial education, right? They just pretty much wing things. They don't really get a good grasp of what it is to retire financially secure or get insight about that. Also, they don't have a financial game plan, right? They don't really know how to get from point A to point B, right? We could plan a lot of things. I guarantee you, if you're going to take a trip to whether it be Mexico, New York, California, you're going to have a plan on how, from when the time you get on the plane, from when the time you return, right? But the thing is that one of the things that we don't plan for that has the most impact is our financial game plan. So it's another reason why people have challenges. And lastly, they don't have a financial coach, right? Typically, we have a coach for a lot of things, right? We have a fitness coach, we have a nutrition coach at times, right? We have a spiritual coach, we even have life coaches, but we really don't have a financial coach who's really going to be there on our side, kind of like our foxhole buddy, to make certain that we're on the right trajectory, right? To make sure we're getting, again, I'm going to continue to say this, but get from point A to point B to where we want to go in retiring and getting out of debt. And, the list goes on and on and on. So this results in serious challenges for Main Street families, right? So again, we try to make certain that they have an advantage, right? So, I could talk about the financial challenges all day, right? But you can read, okay? I'll be honest. The fact of the matter is that, a lot of households have a lot of credit card debt, right? We're not even talking about student loans, right? They're haunting everybody. A lot of people, if they have life insurance, they pretty much don't. If they do, don't have enough, maybe sometimes the wrong kind. 45% of Americans have less than 25,000 in savings and investments for retirement, right? And that's key, especially with now with COVID going on. A lot of people are struggling from a financial standpoint, right? And again, we're always saying like, who's really there to fill in the gap to make certain that they're doing what's right, right? And also, 8 in 10 workers living paycheck to paycheck, right? Or as my pastor would say, from paycheck to pawn shop, okay? And with that being said, and also with the massive layoffs that are happening, right, we can all agree that that affects us from a financial standpoint, right? So I always tell these, show these statistics, not only to say that this is real, this is truthful, but also it's like, man, we're not alone in the situation, right? How are we gonna get out of it? Go ahead, Van. I'm listening.
I have a question, and maybe a statement. I think a lot of the reason why a lot of people don't use the financial coaches is because they think it costs.
Good question. Right.
And they don't have the money, the extra money to pay somebody to tell them how to make more money. Is that true?
Right. And that sometimes is the case, right? Or they will have an annual stipend, right? It could be $200, $500, it could be $1,000, depending on where you go, right? Like I know in regards to in my business, right, there is no annual fee, there's no, upfront charge, in order to get assistance, right? And I think that's really key. And that's one of the reasons also why I decided, to step out on my own is because, for me, when I talked to a friend of mine who actually, kind of shed the light about what this is, what, the financial industry, I was like, man, if I got to pay you to get myself out of a hole, then I really don't know what to tell you. Right. But he was like, Dhemil, man, I got you. Right. I'll educate you. I'll show you. And then I'll lead you, take you on the pathway to get you where you want to go. So, but to answer your question, yeah, they sometimes do. But there are also individuals who won't do that at the same time. Answer your question?
Yes.
Cool. Awesome. Here's the thing, most people don't plan to fail, people don't plan to fail, they just fail to plan, right? I don't think anybody wakes up in the morning saying, I can't wait to follow my face today. If they do, they need prayer, right? I got a good pastor, he'll help you out with all that, you know what I mean? But that's just not the case, right? And the thing is, we talk about the fundamentals, okay? And one fundamental is that I talk to or I subscribe to is bypassing the middleman, okay? Becoming an owner and not a loaner, okay? Typically, when we get paid, okay, at our jobs, if we got one, right? We take our money and we traditionally put it into the bank, right? And all the bank does in turn is it puts it to the global economy, right? That can be from your car loans, that can be from your credit cards, that can be from your mortgages, and they'll charge a higher interest rate off of that amount of money, right? And we already know that, again, banks, credit unions, and insurance companies give us historically low rates of return. So one of the things I like to educate folks is just let them know, like, why not, bypass the middleman? And we already do that already, right? If we bypass the middleman, that being the bank, right, and invest our money in the global economy, we start talking about things where it comes to individual retirement accounts, your 401k plan, that's another way to do that. Mutual funds, right? Annuities. Van and I were talking about that a second ago, right? Additional ways to where your money can grow at a faster pace than it just being at a regular bank, right? Now I'll say this as well, right? That it is important to have a bank, right? But if you look for certain strategies on how to make your money increase and grow, there are other avenues to do that aside from just your traditional Wells Fargo, Chase, and Bank of America, right?
I got to throw in real estate in there since I'm a realtor, but go ahead, keep going.
Yeah, you go in real estate. Okay, let me not talk, exactly. And that's one of the things, exactly. Real estate is a great option to do that as well to make your money get a great rate of return. So appreciate that, Vanda, with the assist. All right. And one of the things that goes on with that, right, making your money grow, right? One of the concepts to talk about power of compound interest, right? I liken this is what's going on similarly in your 401k, right? Or your 403b if you're a teacher, right? $200 a month. Let's say you were saving that, okay, for 35 years, okay, from age 30 to 65. Right? At 3%, that money would have grown to 148,000, 6%, 286,000, and at 9%, that grows to over $592,000, right? Now, I don't know if you can type this in the chat or whatnot, but again, which one would you rather have your money growing at? The 3, the 6, or the 9%, right? And I'm assuming everyone would choose the 9%. right? The problem is that I've come to find out is that most people don't even know where to get the 3%, right? Because again, if you're talking to your local banker at Wells Fargo and Chase and so on, they can't even get you anything at 1%.
Can't even get 1% now.
Yeah, you can't even get that, right? Long gone are the days where you get a nice little CD or a jumbo CD, right, to where you can get a good rate of return. That's not happening nowadays, okay? Talk about one, utilizing the power of compound interest, right? The higher the interest rate, the more your money can grow, okay? But to that same line, okay, let's talk about, and you've heard this before with hope since you've been a child, right? Pay yourself first, okay? Pay yourself first. I continue to say that, pay yourself first, okay? Why is that? Because when you don't, there's a high cost of waiting, okay? Going off of the compound interest scenario, okay? Let's say that you had $200, you were saving that every month, okay? And it was growing at 9%, which is a great rate of return, okay? For 40 years, okay? At 25, okay, you started saving that amount of money. That amount of money would have grown to be $943,000, okay? Which is amazing. Now, if you'd have waited just 1 year saving as well, that money would have grown to $860,000. You waited until you're 30, that would have grown to $592,000. But if you would have waited until you were 40 years old, 15 years after 25, which is when you should have started saving that amount of money, you'd have had $225,900. Okay, which is a difference of $717,380. That's a crazy difference, right?
Yes.
Especially, say it again, Vanda.
Yes, it is.
Yeah, especially, right, if you really wanted to utilize this money. Okay, so again, most people, what they want to do is they want to pay off this and they want to wait until this time and this time. I say, guys, the sooner you can start paying yourself, the better off you will be, right? They're going to get their money, okay? But don't forget about the main person the main person, which is yourself, all right? But I want to say this, who are people hurting if they wait? And again, it's typically ourselves that we're hurting, okay?
Those bills are going to be there.
All day, all day. And what I was saying, they're going to be there, right? Pay your bills, of course, right? Yeah. But don't forget the main person, which is yourself, right? Because you take the most advantage of everything, okay? So, okay, this is what I get excited about. Okay, so this is a rule, honestly, I did not know anything about, and I thought I was a big shot. I went to college, graduated with honors, took a finance class, and they never told me about what in the world is the rule of 72, okay? Now, I can't see your chats, but has anyone ever heard of the rule of 72? Yes, no, maybe so, right? Okay, what this is also called, it's called the banker's rule, okay? And this is one of the rules that one of the banks just don't tell you about. They don't know, they don't care to tell you, I don't know, okay? So what it does is it tells you the approximate number of years it's gonna take for your money to double in an interest-bearing account, okay? So what do I mean by that? Okay, if you take the number 72, this is simple math, all right? But don't worry, I got the answers, so don't sweat, okay? Take 72 and you divide that by your interest rate. The number you get from that is how long it takes your money to double. To make it make sense, okay? Now, I know I got $10,000 here, but this can be $1, you guys. It doesn't matter, okay? You take 72, you divide that by 3, okay? That equals to 24. If you had $1 in an account, $1 in an account that was growing at 3%, it would take that $1 24 years to double to $2, another 24 years after that to double to $4. Okay, I'm gonna let that sink in for a second, right? Have you ever wondered, this is maybe just me, okay, maybe just only me that looks at the bank account, and you ever wondered why when you look at your bank account, you're like, why did I only get it's been in this account for a year plus, but I only got like 5 cents, a nickel that I gained on interest, and I might as well just put this under the mattress. It ain't doing nothing, right? And the reason being is because this is working against you instead of for you, okay? Again, let's go back to 6%, right? If your money is growing at 6%, your money is going to double every 12 years. If your money is growing at 12%, your money is growing every 6 years, okay? So, I mean, it's real simple. Of course, we know which one would you rather have, at the end of 48 years, 40,000 or 2.5 million. Okay. And on the flip side of this is also one of the reasons why it's so hard for us to get out of credit cards. Okay. Especially if the interest is really high. All right? And I say this as well, right? If you ever look, a chessboard and a checkerboard are exactly the same. No difference when you look at them. Okay. But the difference is the rules that are played on them. Okay. And typically, most folks are playing the game of checkers where everyone else in the financial industry is playing the game of chess. So that's why we're not winning, is because we just don't understand these particular rules, right?
Nobody taught us how to play chess. They taught us how to play checkers.
And that's it, king me, and that's it, right? But at the same time, they wiping you off the board, right? And you were just a pawn, right? At the same time, it's masterful how it goes on, right? But again, this is information that our community honestly doesn't know much about, because we're told what we're told, and we just know what we know, right? So again, I thank you guys for joining this evening, at least getting some insight about additional strategies about how to make this work for you, right?
Most people don't know how to get a 12% interest either. So
Facts.
they know about the banks and that 0.5 or 0. Whatever it is they're giving now. Then they get a CD that might be 1% or 2%.
Mm-hmm.
They don't hear about 12% interest or 9% interest. So where do we get that from?
Good question, right? And I'm gonna talk about that, right? And I think it kind of goes hand in hand. It's like, who do you talk to about it, which is key, and where do they find something that averages like a 12% rate of return, right? And I'm gonna talk about that. So keep that in mind, Vanda. Just hold me to that, okay? All right. So, I want to talk about, before I get into the answer in Vanda's question, right? We talk about the 3 accounts that you need, right? Is to have, well, one of the things is you got to have a complete savings program, and most people need 3 types of basic accounts. Everybody knows about a savings account or an emergency fund, no problem, okay? What people really don't know is this middle bucket, which is short-term savings. And I'm gonna get into that in a second. And everyone knows about long-term savings or investments, or retirement is another name for it as well, okay? So like I said, most people know about a savings account or an emergency fund, which the goal is you want to save up to 3 months of after-tax income, okay? Typically within that, you would draw within 0 to 2 years, right? An emergency pops up, okay? A major car and home repairs, home remodeling, uncovered medical expenses come up, right? You want to, and this is why I say, I'll never completely knock a bank, because in the event if any of these were to happen, you want your money liquid or readily accessible to where you can pull from it in the event of any of these things were to happen, right? That's what the emergency fund is for, okay? Now, when we start talking about our short-term savings account, right, we start talking about up to 6 months of income, okay? And this is what people usually don't get to, because remember, most people have less than $1,000 in their savings account, right? Short-term savings, you want to have up to 6 months of after-tax income money that you have readily, right? Here, you usually withdraw within 3 to 5 years, right? It's for unseen events like loss of job, disabilities, right? Short-term purchases like a car, a down payment for a house. Most individuals right now would have loved, or I say, you can see most individuals who were not prepared for this middle bucket when a loss of job occurs, and then they're really struggling or really hit hard, right? And the thing is, it's like, again, going back to the pay yourself first, we always got to position ourselves in a place to where, any event, if our job decides to take a left, we've done things right. Okay. So here it is. The last bucket talks about wealth building, which is, of course, your retirement funds, your Roth and your traditional IRAs, right? Your 401ks, we know about those guys, right? Which are, some are tax deferred accounts, where you can really leverage, right, your money working for you, right? I'll talk about tax deferred in just a second, but also to where your money can make money and it gets a higher rate of return at the same time. Okay, but here's the deal, right? And this is a slide that blew my mind as I thought about it. I wanted to put it down. This is so true. Here's how most people save, right? Most people would say, hey, Dhemil, I got me an account. I'm getting 4% rate of return, right? Which is better than I'm getting in my bank. I think I'm good, my friend. I think I'm solid. okay, it's giving me some good returns. I'm like, okay, great. So in this scenario, all right, out of that $10,000, if it was given a 4% rate of return in the year, that would have been $400 that they would have made by the account just doing what it does. But don't forget, Uncle Sam got to get his money.
Oh, Lord, not him.
Yeah, got to get his money. Okay, he always gonna get it one way or another. Okay, so that took this $400, okay, down to $300. Okay, so now your balance is $10,300. You're like, hey man, I didn't have to do anything for that $10,300 for the extra $300. I'm solid. But one of the things people don't remember or don't think about, because it happens so organically and don't think about it, is inflation. If inflation, which averages about 2 to 3%, probably closer to 3%, that would actually take your buying power all the way back to the original investment of $10,000. Remember, okay, I'm showing my age a little bit. Gas used to be 99 cents, right? Someone told me it was 69 cents at one point in time, right? Now it's $1, $2, sometimes $3, sometimes $5, depending on where you are in the country, right? And they really don't understand that the three things that affect your money are: one, you spending it; two is taxes, and also inflation. That will eat you alive as well. So you got to prepare for all of these things and safeguard yourself as best as you can, so that when those things happen, right, you position yourself in a better way. All right. So
I'll tell you, I remember when gas was 50 cents, but that's okay.
50 cents?
Yeah.
Hey man, let's take it back to those days, right? Man, all right. So again, you got no purchasing power with that. All right. So again, we know what the three funds, right? The emergency fund and short-term savings. But let's talk about the last one, which is the long-term savings or your investments, right? Which goes to your question earlier, Vanda, right? Where do you get like a 12% rate of return at? Or
Mutual funds.
Man, right?
Or real estate.
There you go. Which is a part. Yes, there are real estate companies involved in mutual funds as well, right? So what is a mutual fund? People ask me this all the time, right? Not mutual fund, mutual funds, yes, all right? It's where individual investors, right, pool their money and get it professionally managed, and those professional managers put into certain holdings of certain companies, right? Like your Procter & Gamble's, your Walt Disney's, your McDonald's, your Microsoft, Pfizer, right? And they spread it out to where, you may have heard the term diversification, right? To where they spread it out to where if one goes down, then the other one probably goes up, and you're minimizing your risk at the same time, okay? Now, the higher your interest rate, right? It just means the more aggressive or more stock-based that actual mutual fund is, right? And when it's more aggressive, it's more risky. And with more risk comes more reward, right? So the thing is, you got to just, understand that's how things go. The lower your interest rate, the lower the risk. The higher interest rate, the higher the risk, okay? So, most mutual funds hold more than 150 stocks on average, right? The simplest way I can talk about a mutual fund that kind of wrap my head around it, I kind of tell people, it's kind of like, let's say you have an egg in a basket. Okay, let's say that's Apple. Okay, and if I, just for whatever reason, just drop that basket or whatever, and I hit that egg, that's all of the money. It's Apple. If Apple tanks, then that's it. That is what it is. Okay. However, let's say that you had 2 dozen eggs or 3 dozen eggs, right? And in there was Apple and Google and Pfizer and Walt Disney and Downey and Gillette, right? If I drop it, yeah, some eggs are going to, break. However, there are so many in there that they're going to still be intact, right? To keep your money afloat. That's why, it's good to have mutual funds, because again, it lessens the risk for someone and also gets them a great rate of return at the same time. So hopefully I answered your question in saying that, Vanda.
I love mutual funds.
There you go, right? All right, okay, this is something as well, right? Financial independence number, okay, or your FIN is a short name of putting it, okay? And this is key to know, okay? It's the amount of money you'll need to accumulate so that someday you can live off that money for the rest of your life and never have to go back to work. Can I get an amen?
Amen.
Right? Man, to where money is working for you and you don't have to work for it. Ain't that a good time?
Can I say my favorite saying that me and my husband say?
Oh, give it to me.
Don't let your money get lazy.
Don't let your money get lazy, right?
But
You gotta make it active.
if you working for money, now your money is working for you.
Yes. And the thing is, money don't sleep. I think that's what I love. Money don't sleep,
No,
right?
we need
And
to.
I say this as well, is because at one point in time, retiring used to be a number, or I used to be an age, I should say. Okay. But long gone are the days where you retire at 55, 60, or whatever the case may be, right? You get the gold watch with the plaque and they send you on your way with a pension fund. That doesn't happen anymore.
Mm.
Now we have been, we've taken on that responsibility, right? To where, now retirement is based on a number, and that number is the financial independence number. Okay. So let's say you want to retire in 30 years with 30,000 a year. Okay. That's 30. Let's say it's 30 years from now. After 3% inflation, $73,000 spends like $30,000 does today. Think about that, right? Here's the thing. The financial independence number to make that happen is $1 million. Okay. To get there, you have to invest $585 per month for 30 years at 9% in order to make that happen. Okay. And the thing is, how important is it to know your financial independence number, right? And I would say it's very important, right? Which goes back to financial coaching. What most people do is, and that I've experienced, right, when I'm helping individuals, is they know, hey man, I got a retirement, I got a 401k, or I got some type of retirement account at my job, right? And I just put the money in there, I just let it ride. But not knowing, it's kind of like me saying, okay, I want to go to California, right? I'm in Houston, right? How long is it gonna take me to get there? How much gas do I need? How much food do I need, right? Am I properly prepared to get to California? I know where I want to go, but am I taking the necessary steps, right, to plan and make sure that when I get there, right, my clothes aren't tattered, my shoes aren't worn, right? I'm getting there in style. So that's what we're trying to do, all right, and educate. Okay, here's the thing, taking advantage of tax deferred savings, right? One of those is IRAs, or other tax deferred savings like 403Bs for my teachers out there. Okay, so here, right, if you invested $10,000 per year for 30 years at 9%, right, tax deferred, which means taxes come later, right, that'd be $1.5 million. If it's taxable, right, there's a big difference, which is $739,000, right? So I always say, and just to kind of talk about retirement as well, right? If your job is offering, because we talked about this earlier before the call started, before everyone jumped on, is the importance of, if your job is matching your contribution, you better take that money. I'm gonna say it again. If you're at a job, right, where they're matching what you're contributing, if you can max out what they're contributing or matching with you, I would take all advantage of it, because that's free money all day, right? Take advantage of that. Okay. And again, here I kind of go back to this again as I did earlier about not paying or don't pay the high cost of waiting. Okay. The sooner you begin to save, the less you may have to put away each month, right? So here it is, to potentially have $1 million at age 65. Okay. Would you rather, okay, and you can, I can't see the chat at the moment, but if you want to put it in the chat, you can put number one, this is me, number two, okay, where you would rather be is saving wise. Would you rather, number one, put $214 away at age 27 and 67? Or, if this is your situation, right, if you could have started at 37, would you rather put $46 away till 67? $14.97?
No.
$51.68. Okay. Again, if you're trying to have $1 million at age 65, and this is when you started putting away, $5,168 per month starting at age 57 to 67. And look at age 62, y'all. $13,258 per month from age 62 to 67. All right. And of course, you started at 67, it's just too late. Right.
Yeah.
So to go back, what Vanda and I were talking about earlier, right, is that these folks don't get their money. When I talk about these folks, I mean the debt, debt and things like that, right? But you always got to position yourself to where you're at an advantage, right? So people always ask me like, Dhemil, man, I really don't have much, right? I got $50, right? I got $100. I don't got $1,000 or $2,000, right? I didn't have a windfall of money coming to me. I'm like, if you got $50, that's something.
Better
right?
than nothing.
It's better than nothing. I'll take something over nothing all day, right? If anything else, at least position yourself, because that $50, after a while, you forget about it. And once it's automated, you look at it like, oh man, I actually got some money in there, right? Let me put an extra $50, and it goes to $100, right? And then there are many ways, but the main key I always say to everybody is at least start as soon as you can, because again, you can see the high cost of waiting is just too much. All right. All right. Oh, here's something for my people that owe debt. This is where it gets fun. So this is something it's a strategy I talk to people about. It's called debt stacking. Okay. So for all those who, who got debt, who got a car note, who got a mortgage, who got credit cards, right? Even student loans, if you're paying on them, right? I got to say that little caveat, right? If you're paying on all these debts, right? I found that this solution, this way of doing things has helped people get out of debt way faster than it has been them just kind of, putting $10 extra here, putting extra $100 here. This actually plan has helped out. So I'll show you what I mean by that. Okay, so let's say you typically with debt stacking, you line up all your debt from your smallest to your largest, right? Typically, right? I know the scenario is a little bit different, but let's say you had a retail card, 2 credit cards, a car loan, and a mortgage, right? And that retail card was $220 a month. Okay, now let me ask this, guys. Let's be real. If you paid that credit card off, that $220, like what does the average person do with a freed up $220 in their pocket? If we're being honest, right? Then I'll ask you about that. What does a typical person do, you think, with a freed up $220 that's in their pocket?
Go shopping.
You know it.
Go shopping.
You know it. Christmas around the corner. Thanksgiving is right around the corner too, right? And that's what we do, right? So I say, like, look, let's practice delayed gratification, because this is going to help you in the long run. Okay. So let's say you paid that $220 off. Okay. And instead of, putting it to something, that's not going to give you money, like spending on clothes or whatever the case may be, you take that $220 and you stack it on top of that $353. So now you're paying $573. Okay. You're going to wipe out that second credit card. Okay, now you got $573 that's now freed up because you paid off the retail card and a credit card. Take that $573 and now you add it to the car loan. So they're asking for that $551, okay, on that fancy Benz, if that's what you got in this kid. But now you're paying $1,124, okay? You're gonna wipe that debt out. Now you take that $1,124, you kind of see where I'm going with this, and you add it to the credit card, and then you add it to the mortgage. Okay, so now what's happening is that you're beating what they're asking for. Okay, you're beating the interest. Okay, so if you're in plan A, right, just doing things as we've been taught to do, I'm just gonna pay my debt. Add an extra couple dollars here, extra couple dollars there, right? Your debt's gonna be paid off in 23 years at age 58. Okay, now from what you're thinking of, it's like, hey man, it's not bad. My mortgage is 30 years. So me paying it off at 58, I think I'm still kind of at an advantage, right? Mm-hmm. And you're paying $200,000 in interest. That's a new house, depending on where you're at. Mm-hmm. Now, if someone did the debt stacking way of doing things, look at this. It paid off all that debt in 9 years at the age of 44, 14 years sooner, with $130,000 in interest avoided. Now, here we go. Right? For my, this is the smart class, right? So we take $2,720 that was going towards the debt, and we now funnel it into an interest-bearing account that grows at 9%. At the age of 67, guys, look at that. You can have $2.4 million by the time you hit retirement age. If I was halfway, right, that's 1.2 million, right? See, the deal is that, sometimes people are robbing Peter to pay Paul and sticking up John around the corner. Right? We save because we just got too much dang on debt. That's just reality of it, right? However, if we use this simple strategy, right? And then once we pay it off, we divert it to savings. We can position ourselves in a way better way, right? Now, I just said this is just if you're using debt stacking and then funneling into investments. We're not talking about also you having your separate 401k or your separate IRA at the same time. When you actually combine those together, man, that's magic, right?
Mm-hmm.
I don't know if someone wants to take a picture of that or take a screenshot of that, man, this can really change a lot of people's lives, especially when it comes to how it's actually, how it's worked, right?
Yeah, Evan, that is another name for it, the snowball effect.
Correct.
I've heard of it called that too. And one thing that I learned just recently, and I just started taking advantage of this, is that your credit card, if you have the credit card that has rewards on it, if you use that and accumulate your points and your rewards or travel or whatever to pay your bills, then you get those cards or gift cards, and that's what you can fund your lifestyle with from those credit cards, because you're going to pay those bills anyway. And then when you get your credit card, bill, you pay that, but you're getting all these points from the credit card company. So I just got a gift card. I got 2 of them. They just came in the mail the other day. So I'm like, you know what? It's just accumulating. I'm gonna use it. I've already used the credit card, so I, get those gift cards from it. And I know people that do that with airline miles. They get them on their card, and then when they get ready to travel, they're not spending thousands of dollars in airline fees, and they're just using their credit card.
Because they're using their credit card and being able to pay off the airlines with those?
They pay their mortgage with the credit card. They pay their electricity, their car note, everything on the credit card that gives them points or rewards.
I got you.
Have you heard of that?
Yeah, and I have, right? And that's just being effective at where you're placing your money, right? Mm-hmm. My thing is just don't get over your head, right, when it comes to certain things like your credit cards, right? Like, oh, I got points, and then all of a sudden you got like $10,000 in credit card debt, and you're not paying it down, right? And it becomes too much of a burden, right, versus an advantage, and using the perks that it can be used for.
I did say pay it off every month.
The key point, right? Key point.
That is the key point.
Yes. So of course, you want to pay the thing down, right? So, or pay it off completely. So, all right. No, they don't. Okay, here it is, right? This is imagine this scenario, right? Because this is I try to slow down a little bit about this part because it's serious. Imagine if, right? What if you had a toaster in your kitchen, right? And on the 1st and the 15th of every month, $2,000 popped out of it, right? Would that be a good thing? I would think so.
That would be awesome.
That'd be awesome, right? Would you like that toaster, Vanda?
Yeah, I want to.
Would you insure it? Like, would you give it the best, policy on just like, hey, man, I gotta make sure this thing keeps on doing its thing, right?
Mm-hmm.
Right. Unfortunately, there is no such toaster, but you are the money machine for your family, right? And I talk about this. So it makes, if it makes sense to insure an imaginary toaster, wouldn't it make sense to insure your income, right? So I talk about income protection, okay? And this is something where, we just got to understand, or at least get more insight about, okay? So, here's a real life scenario, right? You got a husband and a wife, and they got a child, right? And these are regular things we all have. We got mortgages, something that's got cars, insurance, credit cards, the list goes on. And $7,000 every month is coming out of this household for this husband and wife. And $3,500 is split between the two of them. Okay. But here's a scenario though. What if the husband don't come home? Right? What will this family lose? Right? Now she has to take the burden on to figure out, man, how in the world am I going to take care of all this stuff? And it's just me. When I was used to John coming in and taking care of it as well, if not taking on a heavier load of it all, right? So I talk about the importance of life insurance, but also talking about that there are 2 options for life insurance, right? And there's always a struggle back and forth about which one is the best. I mean, I think my personal opinion, and I'll talk about that, but there are 2 kinds. One is called cash value, right? It has like whole life, universal life, variable life, and stuff like that, okay? Whereas, you have a benefit, which in this case is $100,000, right? At the same time, right, you can get a cash value savings with it at the same time, right? So $225 a month, right, takes care of both of those things, right? Now, we talk about also, or I actually recommend, right, buying term and investing the difference. Why is that, Dhemil, right? Well, man, for that same 225, you could have got 250,000 on yourself and for your wife, right? At the same, and right, the premium would have been $80. So the difference between the 80 and 225 is $145. We can put that into an investment vehicle. Let's say it was averaging 9%. That's an additional 265,000 by the time they hit 65 years old, right? So, I just really just put it out there. I mean, which one makes more sense, right? Sometimes people just kind of, they come back and forth, which one's better, Ford or Chevy, but I'm just saying which one gives you the most financial advantage, right? And that's why I usually lean towards the right-hand side, right? The main thing is one, getting coverage, but also making sure that it's doing what it is you choose that is best for you, right? I also say this as well, just kind of, stay on my soapbox for a second, is that life insurance, right, is not just meant to bury people, right? It's meant actually to build a legacy, right? Now, I'm not a biblical scholar, but I do know one thing is that a man should leave an inheritance for his children and his children's children, okay? And one of the best ways to do that, right, is through life insurance, okay? Now, I don't know if I actually go in here, I don't, but I want to say this as well, okay? Remember I was talking about the rule of 72. Let's imagine how to change, and I was talking, if you were here earlier, how to change the community from the inside out. God forbid something, okay, I'm sure we would all agree, if our parents left us $500,000, right, we would be ecstatic, right? Oh, Tanya, you got $500,000 that your grandmother gave you, right? It's your inheritance. You can do whatever you choose to do with it, right? Within reason, okay? Now, imagine you taking that $500,000, okay? And then you put it into an investment account that uses the rule of 72, goes where it grows, let's say at 12%, where it's doubling every 6 years. And let's say that happened to you when you were like 10. Imagine where you would be when you're 40 or 50, and how that amount of money would not only change your life, but your children's lives or your family's lives, right? Or more importantly, how you can influence the community if that was a possibility. And what I don't get, or I kind of understand why, because we're not taught these things, but most people, again, just say, hey man, I'm getting life insurance just to bury me and call it a day, right? But you don't understand the financial impact that not only can do for yourself, but for your family and the community around you. Imagine if everyone in your family or everyone in your personal community, people that may look, that you vibe with, right? All that happened at the same time to everybody, and they all use that same formula. I'm sure everybody, like the community, would be completely different. So I was on my soapbox about that, but I always talk about the importance of actually using it as an effective way, in addition to just burying people as well. So here it is, right? This is called the theory of decreasing responsibility, okay? It's really how life works regarding insurance and investments, okay? At one point in time, we got young children, some of us, right? May have some debt, may have a mortgage, okay? A loss of income on the left-hand side would overtake those who are left behind's income, right? A spouse, a mom, a dad, a sister, a brother, a cousin, a friend, right? That's why it's important to have life insurance on the left-hand side, okay? Now, as we move from the left to the right, if you're looking at the top line, you see it kind of curves down a little bit, right? Because your responsibilities are decreasing. If they had children, right, they're growing up and left the house, praise God, right? You had debt, you lowered it, you paid the mortgage off at the same time. Now, at the same, right, your money should be growing because you've been saving it, investing it, all that great stuff like that, right? Whereas if you had, I used to say $2 million, but someone told me that's not enough. I was like, all right, let's say 5 million, even 10 million, right? On that side of life, right? I always say, do you really still need life insurance? Like $100,000 worth of life insurance, right? Now, I'll say this, I'm never going to, hey, more money is great money. I'm never going to disagree with that, right? But the deal is that on the right-hand side, you want to be financially independent of life insurance, independent of Social Security, independent of everything, to where if you need to get it taken care of, you can, right? Whereas on the right-hand side, those things are more of options versus than they were on the left-hand side, which is where they were obligations. And that's the key. right? Is making sure you're properly prepared for that, right? So again, dying too soon, of course, living too long. And I'll say this too, what life insurance company do you know of that teaches people how to eliminate the need for life insurance? They want you to hold on to that thing until God calls you home. But hey, I just have a different philosophy about that thing. All right. Again, you can always keep it. So here it is, right? A good rule of thumb, right? To build your financial house, okay, is to say, we want to have coverage between, 7 to 15 times your annual salary. You also want to take into account your financial goals, education costs, if you got kids under 18, debt, and so on, right? And this is how usually a financial house is built from the bottom to the top, okay? Life insurance at the bottom, getting a budget, getting an emergency fund, right? Get the savings right, getting out of debt ASAP, getting a retirement for yourself also. If you got kids, preparing for college, and your other goals and dreams, that's like, vacations and cars and stuff like that, and taking care of all that good stuff, right? So in conclusion, guys, I'm coming to a close. I always say this quote, when I actually got involved in the business some time ago, my mentor told me this, and I was just, blew my mind. He said, Dhemil, if you save money, one day money will save you, right? And I hold on to that because I think now, more importantly, people, if they did save money right now, especially with the pandemic going on, they'll be in a better position in order to save them as well. So, I said all to say this, I want to say I appreciate it, you guys. That is my time. I want to thank you all for joining on this evening. Then what I'm going to do in addition to that, here's my contact information. I'm going to put something in the chat. Okay. It's a simple form, right? I'd love for you guys to fill out, just to kind of get some feedback and just curious for my part. It helps my record keeping. But this is my information. If you want to reach out to me, I'm available anytime. There's my email as well. I want to thank Vanda, okay, real estate expert, eXp Realty, for actually, like I said, sponsoring this event and allowing me the opportunity to speak with you all this evening. And I don't know if you got any questions or concerns or anything like that. So I'll leave it open. We got a short period of time. So
Put the form in the chat.
Okay, let me do that right now.
And if anybody have any questions, you could take yourself off mute and ask questions or comments.
Oh, I love it. No questions, no comments.
Well, I got a question.
Go ahead.
So when you were first beginning there, you said that most financial planners do not charge a fee?
No, most actually do. There are some that do, and there are some that do not.
Okay.
Regarding the some that do not, I'm uncertain. I do know there are some that do, though. I know for myself, I do not. And I know, I guess it really depends on the company, to answer your question. Who does and who does not. And if anything, if they don't charge, I've also heard that there are some who may, they may give you the service like life insurance or may give you the investment, but then to do, for example, like a financial program, there may be a stipend to do that on an annual basis.
And Evan, what some of them do is if they invested in, let's say, an insurance company, then the insurance company pays that person for bringing you to them. So they don't charge you, but they're being charged. They're getting paid somewhere.
Gotcha. But let's say at minimum, they only charge like maybe just a service fee, or is it like an ongoing?
It depends on the company. Some may do it on service fee. Yeah. Yeah. And these are great. And that's a good question to ask. I'll be honest to say, like, the program that you're providing me, is there an annual fee, attached to that, right? Or is this helping me out, to get myself in a better financial situation? So that's a great question to ask.
Okay.
And some charge according to your account.
Facts.
If it's growing a lot, they're going to charge you more money because they're helping it grow. So they're going to charge you more money.
Right. Good question, Evan. That's a good question.
Anybody else have any questions? Everybody click on the form, please. We appreciate it. And I will send a recording out to you guys. If you have anyone you want to share it with, please pass it on because I think it's good knowledge, good free knowledge.
Awesome.
Thank you, Dhemil. I appreciate it, and thank everyone for coming.
No problem, no problem. Thank you guys. And like Vanda said, if you could fill out the form, it'd be great. And until next time, right, we should reach out to you. Awesome.
All right. Good night.